what is it that you want from the investment? Is it cash flow? Is it tax mitigation? At the end of the day, you have to be profit positive.
Hello, everyone. Welcome to another episode of Ask the Multifamily Expert. Today, I am super excited because it's not really about multifamily today. It's about NNN, triple N. People call it triple N. I know some of you have not heard about it, or you've heard, but you don't know the benefits about it and how you can also combine it with multifamily. So today I have with me Julie Raw. She's going to be walking us through because she's one of the masters I know in triple N, and also she's also investing in multifamily. So there's no other person that can tell us exactly what we need to know about triple N and multifamily. So, but before I get her to introduce herself, I would like to say a little about how I met Julie. I met Julie through a mutual friend. Her name is Brooke. Brooke, shout out to you. I met her through a deal. Brooke brought a deal to us, triple N, and as at that time, I had no clue what triple N was. All I knew was multifamily. So I was so interested, and I said, I would like to listen and know more. And she organized the webinar for us, and I was blown away. I was like, oh, this is exciting. This is another way I can consistently get cash flow and not have to do the heavy lifting. Someone else is doing it and all that. I've not done any deal with Julie Roy at that time. So I took a bold step and said, okay, I was going to do this. Guess what? That same month, we got distribution. And every other month from that first day, we've been getting distribution. So this is one very beautiful thing about triple N. If you are a cash flow person, you just want cash flow. You're not particular about appreciation and any other thing, this can be the right investment for you. But today we'll not just be talking about triple N, we'll be mixing it up with multifamily, how you can do both and succeed. So today, like I said, I have with me Julie. Julie, please, can you please tell us who exactly is Julie? I know you are a serial entrepreneur. I want to know everything about you today.
So thank you first and foremost, baby, for having me on today. I've never met you in person live to hug your neck, but we've always chatted via Zoom, or, we obviously know a lot of people in common. So first and foremost, I want to thank you for letting me come on today. Secondly, I want to thank you for taking that bold move, barely knowing me, through Brooke, and giving me your hard-earned capital to invest. So really excited, to have you as an investor with us, but more excitedly happy that you're getting distribution and that the investment was good for you, and that sparked an interest in TripleNet, because it is not for everyone. It is not, something that a lot of people even know that you can do. So I guess, what is Julie Roy? Well, I am a serial entrepreneur. Or who is Julie Roy? A serial entrepreneur. I'm a mom of 4 kiddos. They're bigger now. So they are now 20, 19, 15, and 13. So they're growing up, and it's really fast. And you can't imagine how quickly it goes when, all of a sudden you're 50. So I've owned and operated businesses for the past 30 years now. It's a long time, but have grown businesses. I would say my superpower in entrepreneurial world has been scaling, helping others scale, helping others acquire businesses, helping them exit. I love people. So I was, always really invested in our teams. I love the execution, the strategy, the creativity of entrepreneurship. So I am an entrepreneur at heart. I'm looking for a business currently. We're always currently looking for businesses. We buy businesses either whole or fractionally. Our children are very entrepreneurial. They're doing private money lending. They're already doing fix and flips. Our kiddos are very interested in the entrepreneurial side, but also in the investing side. So they're currently in a deal with our friend Tommy Jones. Yeah, for some fix and flips.
Okay.
Yep, they are a client of Brooke's. Zoe is her youngest client. So my 14-year-old has invested in that deal. So, it's a family affair, baby. We really believe in creating wealth through real estate and showing our children the things that are not always possible with just a job or a W-2 or just a business, right? I mean, not just, those are all awesome things, but in order to create wealth, you have to store that money that you make, and then you have to, when you get enough, invest it to work for you. And a lot of people don't understand the reasoning behind that. They're like, well, I invest in stocks, or I just save, and I just save my money. But you're making maybe 5, maybe 6% at max if you're in a really high yield account. With real estate, our returns have generally been about an 18% return overall on the investment. Sometimes we've doubled our money in investments through multifamily. There's consistent cash flow. So we currently live off right now passive income only. And so we do, over $100,000 a month in passive income. It's really great. It's a way to live without continually having to work. We love it. We still will work because we need purpose, right? But it does free you from the world of having a ceiling, all those things, right? But it takes money to invest. So people always say, well, how do you get there? Obviously, for us, we had a large capital event. I was able to sell our businesses to private equity. That endured, a lot of capital. It opened a lot of capital for us. However, if you're not in a position to sell a business, but you have a W-2 or you have a business, make sure you're storing some of that money to invest into real estate. Real estate is a wealth building tool. It's not just something that you put it in and you get a quick return. It takes longer, it takes nurturing, it takes time. Sometimes it's fully passive. We'll talk about the triple net side. Sometimes it's more passively active, I call it, which is more that my family,
I'll
the
call
deal.
it actively passive.
Actively passive, so that because you are involved in the multifamily, you are managing people, you're managing leasing, you're managing apartments, you're managing occupancy, you're managing vacancy. With our triple nets, we don't have any of that, but it costs more to get into triple nets, right, than it does for multifamily. So there's a lot of things we can chat about in that. But yeah, basically I'm a mom, entrepreneur, came from a single mom, she worked tons of jobs, 2 at a time, mostly always. I was a first generation Canadian. My parents were Italian, hardworking family. They had a very big sense of morals, integrity. We came from a very tight knit family in the sense that respect was really important, loyalty, integrity, like the things that really mattered in life. We got in a really young age. And I think that helped us in business, with having people follow our journey, having folks come to us because we're going to tell them, right, the truth. And so sometimes that's a hard thing to find in the real estate world. And even in the entrepreneurial world, I feel like there's very few people we can trust as well in investing. It really takes a lot you need to know who you're investing with. You need to trust them. You need to like them. You need to know them. You need to know how they live. You need to know if you align with them. And so that's kind of my quick bio, I guess. So I had a couple figure exits, 8+ figure, both of them. So we were very blessed, and I'm very grateful for those things, but it's also what you do with it as well,
Exactly.
Yeah.
Thank you so much for that brief introduction. Okay, so now let's dive into today's topic. Today is about how people can diversify triple N into other investments like multifamily. So before we even talk about diversifying, what is triple N? Because it took me to come to your webinar for me to understand the benefits and all that. So can you just give us a summary about what triple N is and the benefits?
Sure, I can give you a really shortened version because we could go, really long. Well, short is never short with Julie, by the way, you'll realize that. It just basically means when you buy the entity, the real estate, the property, you're buying it with, generally for us, there's a lease in place, but if not, you have to find a leasee or someone to lease from you. But when that person gets in your building, they pay everything. So you just get a rent check deposited into your account monthly. There is double N that you're responsible for some things. Triple N, as a landlord, I'm only responsible for roof most often and structure of the building. So how we avoid even that is we buy brand new, or we buy within 1 or 2 years of construction. So everything is still under warranty and everything is still new. So we don't really ever encounter an issue with even the roof. I mean, structure is always usually covered, but if there was a roof issue in the beginning, right, we would know and it would be warranted. Normally, triple net, like I said, one of our favorite triple nets is Starbucks. I can do a little case study just because we have quite a few of them, and I'm a Starbucks junkie. Sorry to all those who are not, but you will get to know, if you know me, every morning I'm lining up in our Starbucks to support the tenants. But basically what happens is Starbucks corporate, they are expanding their businesses at an alarming rate. As you see, they're coming up everywhere. In order to do that, Starbucks uses capital, money, right, to build their business. Well, if they had to buy the real estate at every single single Starbucks that they had. Could you imagine how much capital that would suck? So then the cash flow would be negatively affected, BB, from the absorption of all the real estate, because you need down, you need 20%, you need bigger payments right now with the rates, all the things. So they're like, look, we're not in the real estate business. We want to grow the company. So Starbucks is growing operationally the companies, right? They want new and more locations. Their targets are like 100 locations or something a quarter. It's crazy. They're growing at it all over the world, not just in the US. So they call us, literally, it depends where they are. If they know we have them, they're like, hey, we're opening another one, 5 miles from the one you have. Do you want another one? So we can say yes, or we can say no. We have brokers too that call us before they're even ready for construction. So it's kind of a market situation, but it's not always, right? You can find them on market as well. But when you're kind of a landlord, you kind of get first dibs on good locations because they know you'll close. They know there's no nonsense, right? And brokers like to work with people that they know are going to come to the end of the plate and close the deal, right? So the triple nets we buy are brand new generally. They have at least a 10-year corporate guaranteed lease. What that means is that Starbucks Corporation signs a lease with you, but it's not just for that store. They sign the lease for that store. So say it's $100,000 a year of rent, okay? Then they give you $10,000 a month, okay? That $10,000 comes in your bank account on the first of the month, no matter what. Like, it doesn't matter what's happening. It doesn't matter what revenue they make. And we always have one tenant in those, because when it's corporate guaranteed, they own the whole building. So we own the building and the land. They rent from us, okay? But just for that store. But when they corporately guarantee your lease, that means Starbucks all over the US would have to go bankrupt for us not to be paid. So there's some level of protection for us, our investors, and it's consistent monthly deposits. So people, one, like monthly deposits. Two, they like that they know exactly every month they're going to get $571.11. Like, they know, more or less what's coming in their bank account every single month, pretty much on the same day. We get paid on the first, like our checks come in ACH. So through the bank, as soon as it hits my bank account, it dings me. I go over to cash flow portal and I just press distribution. Everybody gets their distribution within 7 days.
I get my distribution. Yes.
And so like every day on the 6th or 7th, you'll receive your distribution like clockwork. People enjoy that because it is more consistent. They can rely on the cash flow coming in. Their capital goes out. So like if their investment is say $50,000, yes, that 50 is gone, but now you have an ownership share in that actual building and land. When we do syndication, so we have a portfolio we own entirely.
Yeah, that's the question I wanted to ask you. So how do you differentiate multifamily to triple N?
So we have three, we use something called a triad structure of investment. It's the Roy trademark triad, we call it. So in the top, we have triple net, which we have a entire personal portfolio, just Bo and I, my husband, for the Roy family. That one we own all of ourselves. That's what pays us a month. That has nothing to do with the syndication side of triple net. The syndication side of triple net are the Starbucks, everything we own with other people, TLE, we have other entities. That I just get a portion for GPing those. Okay. So I'm the general partner. Sometimes we have other GPs. Sometimes it's just us. And we have LPs, which is limited passive investors. Then this kind of corner of the triangle, we have multifamily. So what happened was, BB, I was making a ton of money from triple net. And I was like, great, this is awesome. I don't have, I have all this money coming in. Well, the end of the year was like September, October. And my accountant said, hey girl, like, what are we doing with the tax? I was like, what tax? I'm living passively. And he was like, yeah, you still pay income tax on passive income. And I was like, what? Like, what are you talking about? So that's how, like, literally I had no idea. He was like, look, what we can do though, is we can find other investments to eradicate that passive income. So I was like, what? Tell me more. Then I went to a group. I have a billionaire group I belong to. And I was talking to a couple of those high level multimillionaire billionaires. They're all at the table saying, well, Julie, we don't pay any tax. I was like, excuse me, what? Like, what are you talking about? Tell me more. And because I had always been a business owner, just used to paying tax. Active income equals tax to me, right? And they were like, oh no, it's is what you can do. You can invest in multifamily. The government loves when you provide housing for folks. They don't want to do that. They give you an incentive called bonus depreciation. I was like, tell me more. So they were like, well, this is what you do to eradicate this much. At that time, it was 100% bonus depreciation. So I was like, whoa. So I stacked up, baby. I bought millions, literally, of multifamily because eradicated all of my tax, not for 1 year, not for two. We're going on 3 or 4 years, and I have still a deficit for next year as well. So it's really important to use these different avenues to fit the portfolio, your portfolio needs. So triple net brings me income monthly, standard, consistent income, which I need because I've replaced my sale of my business, and I've put in this money is what we're living off of. So we needed income. So here's my income. Here's my tax eraser, all my multifamily. We just keep the tax by investing there. And then the third area is what I call my risk purse. So in this area, I do business investment, fractional business ownerships, partnership, storage, industrial, things that are what we consider more high risk. And it's managed to a certain percentage of our portfolio. So all of those three give us the ability to increase our income, not pay tax, and have a little fun with investments.
Yes. So you've answered my second question, because the question was, what's the advantage of diversifying NNN properties into multifamily? And you said it's basically getting the cash flow and using multifamily to write off. So explain that. How does multifamily help you write off your passive income from triple N?
Sure. So when you invest in triple net, right, there is a cost segregation we do. And at the time, multifamily was about, 10 times more back in 2021. Now it's a little less because between rates and the bonus depreciation going down, it's getting more on par. But at that time, I needed something with a bigger bang for our buck. So when you invest in multifamily, they give you something called a negative K1. So when you are an LP or a GP, you get this negative K1. What the negative K1 does is it actually, because I'm making fully passive income from the triple net, right? I don't have active income at this time. I didn't at that time. That multifamily was like basically anything that I got off here. Say I got a negative $100,000 K1 from my multifamily. I just eradicated 100,000 I made in this bracket. So it kept taking off the income as we went. And so my tax just kept going down, down, down until I actually eradicated so much. I have a deficit now where I've overpaid, like I've overinvested. So I continue to roll it over to the next year, which is also nice because people don't realize if you overinvest, you can use that for the following year, It's not like it expires. So I call it my negative K1 cloud that I use and I just keep pulling down as I need. So again, this year we are tax-free. We also have, a big, nice purse for next year already. And now we're in fourth quarter, our strategy meeting with our accountant. We've already had a conversation on the phone. Next week, we meet with him in person and we will exactly see, okay, do we need to make any further investments for next year? So
I believe we use the same accountant. You're with Tom Wheelwright, right?
Well, he is our overarching sort of philosophy, but our accountant is actually Vince. He does a tax strategy and accounting, and we use an ex-IRS agent too for creative high net wealth strategies. And so a few things we're using because we also now have active income from coaching. So there's a little bit more of a little more going on. Yeah. And obviously, like I said, we're closing on businesses too. So that business closing is also a tax strategy. So we use buying businesses as a tax strategy now as well. So different things for kind of different areas of our portfolio. But what we love about it is that having the different areas suits the needs for our income, erases the tax, and diversifies our risk because our portfolio then becomes diversified with different asset classes. Even in my multifamily, like I have some diversity. I'm not doing it all in one state. I'm not doing it all with one person. We're one class. We're pretty B class, folks. But in terms of areas, diversity, geographical dimension, economic dimension, it's kind of diversified, right? And over here too, we have fix and flips. So not only are my kids private money lending, we are too, because that's a different area that makes 10, 12%, right? Faster, closer, not as much liquidity. It's more of a return on investment. It's a quicker way to make cash to reinvest in another, asset class. So, so we're kind of all all over them with investments in that sense.
Thank you so much. Invariably, with what you're saying, it just depends on someone's preference. And besides that, multifamily just gives you the opportunity to write off those large chunk of cash flow you must have gotten from deals. Because I can assure you, if you invest with Julie on her deals, you will be sure to have cash flow. So when you start having those kind of cash flow, you also need someone like Bibi to write off those to write off those excessive cash flows that you're getting. So with what Julie is saying, you need different strategies in order for you to scale in your investment journey. And Triple N, I just recently went into it and it's been fantastic. I like the idea of cash flow. Cash flow is my two goal. Appreciation is my second. So, but the tax benefit that comes to multifamily, you cannot overestimate. Last year, I made millions on just K1s, negative K1s, and I've not even used a pinch of it. I still have a lot to use and all that. And that's just the benefit. And that's when you hear people saying, I pay no tax. Really, that's the truth. That's the beautiful thing about investing in multifamily.
Like we can show you negative K1s, like we can show you our tax. I mean, our filings are, negative, but if you were to add the depreciation back, you're millionaires. I mean, literally that much depreciation we've been able to incur. And so I couldn't be more grateful and more appreciative for the multifamily side, because I wouldn't be keeping my money. Do you see what I'm saying? I'm either investing in multifamily or I'm giving it to the IRS. I mean, that's the option. So,
but Julie, I have a question for you about the Triple N. Is there any tax benefit of any sort? Okay, please.
There's about 20 to 30%, Bibi, on every triple net. So if you're buying a triple net for $2 million, right, you have about 20 to 30% cost seg, and we send out the negative K1. So you should have got one, for probably, you probably don't need it because you have all these other ones, but it's probably in your negative K1 pile. But it's going to be like less because
you have not checked it. So you get, okay, I'll go look at it.
Go check it. It's in your portal. Just pull it out. But the thing is that we do a cost segregation. It yields about 20 to 30%, but there's a difference. So there's two things. When we buy our triple nets, we buy them cash. We have no debt. So when you don't have debt, you don't have as much depreciation. That's just how it is. The more debt, the more depreciation, right? The other piece is that our properties are, let's call it $2 to $10 million, where multifamily is like 15 to 300 million, right? So the numbers are different because of the magnitude of the sale price. The numbers are different because of the magnitude of us not having any debt, where if you're having debt on a $50 million acquisition, you're going to have a lot of depreciation, but you also are going to have a lot of LPs that you're going to have to, split that, right? With us, the reason why you get about 20 to 30, even though it's a lower number, we only have maybe 15 to 20 people in our deals. And almost always I know everybody. We're friends, or we've had a friend in common. And so for our deals, you're getting more per dollar you're spending in the triple net, but you're not getting huge because our max is maybe, I think our biggest triple N was like 8.5 million, but that was, I did art on our own, right? So syndicated, it might be like a Starbucks, 3 million. So you're not getting 300 in depreciation. You're getting 20% of 3 million and sharing it with like 15 people.
So based on what you said, the idea of not using a bank to do the loan aspect of it, I know that is peculiar to you and you have your reason, but let's say someone was to use a lender. What's the difference between doing that with NNN and doing that with multifamily?
So you would still get the depreciation, Bibi, a little bit more, maybe like 35 or 40, depending on, also we do new, right? Brand new. So that's another thing. If you're doing new, you get less depreciation because it's brand new. If you've got something that needs capital investment, or you buy a plaza with, 30% vacancy, you have to do all of these improvements. So there's a lot of different things on here that, you have to take into consideration. Our triple nets, like I said, are very tight knit. We know almost everybody. We to do retail. We don't suggest doing retail. We don't like to do plazas. We don't like to do multi-unit commercial unless I know the person, it's full at 100% vacancy. But all of the stuff we do, I would say, 98%, except for one commercial plaza I'm in with a friend. Everything else is 100% one tenant, corporate guaranteed, and like paid cash. So that's just our philosophy. People do triple net differently, but triple net means you're just the landlord, period. Like, you're not really worrying about other stuff. But if you have multi-tenants, and a lot of folks now they're getting into triple net and they think they know what they're doing, but having a lot of units together and vacancies, that is where you come into problems, because then you're kind of getting into that space where you're going to have negative cash flow sometimes, where we don't, because we have corporate guarantees, we have one tenant, we have pretty large like AAA tenants, right? So there's so many different areas you can go into triple net. Ours is specific.
Yeah,
so
I noticed. So my next question to you is, what should investors look at when assessing multifamily investment opportunities, especially if they are used to NNN deal? I know because you're very used to NNN deal, and I believe when someone approached you with a multifamily deal, it sounded different. The opportunities were different. So how would you advise investors to look at that if they have a background of triple N coming into multifamily? Someone like you that not had any experience in multifamily, let's say, and I'm coming to you and saying, Julie, you need to invest, you need to diversify your fund with multifamily. Remember, you're used to steady cash flow monthly, but multifamily doesn't give you sometimes monthly cash flow. Sometimes you don't even see it for
cash
1
flow.
year. Yeah.
Right. We were talking about that before this. So I think you have to change your mindset. So for me, when I look at multifamily, I think tax incentive. I don't think cash flow, because cash flow is a bonus in multifamily. When I'm going into a multifamily deal, one, I have to know the operators. I only work with 3 to 4 operators, very specific folks who are paying investments, who are paying, every quarterly investment, who understand the pro formas. They're not making ridiculous pro forma assumptions, because what happens with multifamily is, oh, we're going to raise rent 10% this year, 12 the next year. That's not going to happen. So if you look at a pro forma and it looks too good to be true, it probably is. I've found that out very quickly.
I've seen a lot.
I've made mistakes in multifamily investment, which is why I'm really particular now. I have invested with some very big gurus that are out there practicing and preaching lots of things, coaching lots of people, and their deals all have capital calls. And, that is not impressive to me, although I knew I got into it for the tax write-off. So I got that, it was paying into this multifamily or the IRS. So yes, I was happy that I got the tax write-off, but learned a lot of lessons about who to invest my money with. General partners, who is most important. If you don't know the person, they don't have a history, they don't have a good track record, talk to other investors that invest with them. I say that to everybody. Like, talk to everyone about me. Talk to everybody about GPs that you're investing in, because I didn't do that. I assumed because of their, grandeur in the market and what they were doing, I was like, oh, that's an easy,
like, and all that. Yeah.
Those are the ones I got burned on all of them. So that to me is like, that's not happening anymore. I'm talking to other investors. I'm seeing historically what they're paying out. I'm looking at what the pro formas that they created were, like how they were, and are they actually reaching those pro formas? I'm very particular. Like I said, I have a very small handful of people I'll invest, well, in all of the areas really, but particularly for multifamily, I look for who am I investing with? Do I trust them? Do I know them? Have people spoken to me about, how they are as a general partner? Do they have the investor at the top concern? Like, I would forego being paid for my investors. If you can't do that as a GP, I don't want to be in your deal. And that has happened to me now on 4 deals with people that continually get paid on the investment, but the LPs are not. That's not cool. And these are people who are teaching this stuff. So there's a lot of people. You have to be very careful of who's out there.
That's what I tell people. Go beyond the superficial, the branding. Yeah. Go in details. Know who these people really are, because it's very important. You're actually investing in the people. Why do I say you're investing in people? Is because you're investing in their belief. You're investing in their integrity. Some people know the underwriting is wrong, but they still present it to you anyways because they know they're going to make money from it. So
they make promises they can't keep, Phoebe. Like, I have no use for people that are trying. I mean, things can happen. Be transparent, be honest. Let's come to the table, discuss what's happening, or take care of it yourself. Like, if I have anything happen on the property and I'm like, you know what, I'm not involving my investors, I pay for it. If it's something small, whatever, like I would never put their investment at risk, and I would never try to not be transparent about something, and I feel like those are the things that upset me as an LP. So I really try to be what I didn't like in the experience, I think, and it really just boils down to, like you said, you have to know and like the person, but everyone looks good on paper. I will tell you, social media, everyone has a perfect life on social, and everybody's making millions of dollars. But I bet you if you ask them for a stamped bank personal financial statement or a list of properties, they will not be able to provide that to you. And I've done that now. Now my GPs, I ask for a personal financial statement. I ask for an income balance sheet or a cash statement. I want to know, like, what am I dealing with? Because if you're going bankrupt in your personal life, I don't want to invest with you. That means you're not ready to have other people in your deals, right? And I'm transparent. If somebody needs to see something from me, I don't have a problem. I have a bank personal financial statement, which I'm not going to post online. But if you're my investor and you want to see, we can have a conversation privately and I will show you that, I think it is really important though. Experience supersedes a lot, but you also have to understand that even experience sometimes, like some of these gurus who, they did really well when the market was favorable. The market is not as favorable. So you have to have people that are really, really understanding the pro forma, the numbers, the underwriting. Otherwise, you can find yourself, in problematic situation.
Exactly. Like two people brought a deal to me. They wanted me to join them, and I'm busy scrutinizing because my superpower is acquisition, underwriting, and I'm very technical. So I ask questions. So in that meeting, we're going back and forth, and I was asking line by line your projections. What is behind it? And the reason is because I'm going to invest in this deal if the deal pans out, and I want to be sure that the projections are correct. Aside from, because I know those people, yes, they have integrity and all that, but now the numbers. So according to what you're saying, it goes beyond just knowing them, also going through their performer, be sure that those performers are really achievable. And there's one particular questions investors need to always ask, because I did a video recently about things you should ask before you start investing. There's one particular question that investors do not ask. What is the risk? Every investment has a risk. And that will lead me to my next question to you. What is the risk of investing in triple N?
So for example, in our private portfolio, we have a lot of different ones, like a lot of different companies, right? But again, we have corporate guaranteed companies, but like lots of times the companies can close locations. Okay. Mm-hmm. So if they close a location, what does that look like for you as the investor if there's only one tenant? So the good thing, like I said about triple net, if you go with a corporate guarantee, is the risk is low because they have to close everything either in the region or the US for you not to be paid. So the risk is definitely lower. However, if you're doing a strip mall or you're doing a commercial plaza, vacancy rates can affect you just like multifamily. The risk is very similar if you're going with a multi-tenant strip plaza, the mall. Do you see the mall?
The mall, yes, the mall.
Okay,
yeah.
so like
Malls,
strip plazas, commercial plazas. If the mall, when you invest, is 100% full, great. If the mall becomes 80, 60, 40% full as you own this thing, there's risk for you to lose your money in triple net, which is why we don't go that route. Also, if you have a variable rate, loan like multifamily on this property, if the rates change and you have a vacancy issue, it's the same thing, which is again why we buy cash for our investors. They're like worst case scenario, they leave, we re-rent the property, we're still getting paid from the original tenant, and we own the land and building in full. Nobody is coming to take that from us. So worst case risk is you own a piece of share that is no longer tenanted, but you're still being paid. So for us, it's a little different, which is why my strategy around triple net is very different than all these. I see so many, I'm doing triple net now. I'm doing triple net now. All these multifamily people who, didn't do well in multifamily, now they're trying to do triple net. They're going to do just as bad in triple net. Like I know so many folks, they're doing the same mistakes because they don't understand the concept is there's going to be vacancy in multi-tenant use, period. Somebody goes back, somebody leaves, someone can't afford the rent anymore, and you have a loan. So if you're not leveraging your loan at least 60-40, where you have 60% ownership, you have just as much risk as a multifamily multifamily, as storage, it doesn't matter. So if you can control the risk, which I'm a control freak, so I control the risk as much as I can. Now, if God help us, a hurricane comes in, takes out our, location in Tampa, which I was concerned about on our private portfolio, then yes, there would be rebuilding, there would be time of no tenancy, but I have business interruption insurance. I've covered everything I can for even natural disasters. I pay an extra premium. I have a policy riders, right? Like you have to be prepared as the GP. Now, thankfully, I only have those in areas like that are my personal ones. The rest are like Midwest. I mean, I guess you could get hit with a tornado, but natural disasters are a little harder to avoid, BB, than tenancy issues, vacancy issues, toilets, trash, tenants, termites. Like we don't have those issues because we are strategic and intentional about our buys.
But I just think these things are very unique to you because other people I've seen doing triple net, this is not their strategy. Some of them take on debt, but your strategy is I use my funds and if need be, I bring in LPs or co-GPs to come on board. But the bottom line is I'm mitigating my risk, first of all, from not bringing in debt, and two, one tenant that is, how did you call it again? A tenant that is that can lease with you for a long time, and they have, you called it one name. Can you remind
corporate
me?
triple net, a corporate tenant,
corporate tenant, and
triple A rate.
Yes, the rent is secured because of the type of tenant you have and all that. That is very, very interesting. Your strategy is the unique thing. It's not that everybody is doing triple N like that.
No, and it's unique. It's unique to me because I am risk averse. I'm 50 years old, I'm 30. So I don't have this huge timeline of risk. And people who like triple net that want cash flow, BB, are people trying to get out of W-2s or people trying to get out of maybe a business or whatever. They need the cash flow replacement, but they don't want a huge amount of risk because we don't want to go back and rebuild again, right? Exactly. We don't want to go back and rebuild everything. So we do investments in other areas to mitigate the wealth, the tax, that stuff, but we're not doing those I'm not doing super high risky investments. I'm only doing that in this little tiny third quarter that I have a percentage of my entire portfolio. It's less than 10% of the entire portfolio. So this portfolio might be around, I think it's around 650 million now, the portfolio. This little section over here might be 50 million. You know what I mean? Like, so it's a very small percentage of the entirety of our portfolio. And that is intentional as well because of my age, because of my risk profile. So I think the first thing LPs need to do is identify what is your risk profile? What are you comfortable with? How much that like? I also tell them like, don't put all of your money in one asset. That is a really bad mistake. I did in the beginning, I was putting 250 because I had the capital in each deal. Well, that risk profile was a lot, right? So I always suggest 100, 125 be the max. If you're in triple net, you can do more because it is more like stable. I have GPs that have come in with me on triple net deals that have put in $500,000, but because they want a couple $1,000s a month, in cash flow, right? First and foremost, identify your risk profile. Secondly, know your GP, know what you're looking for, be aligned with the person, the property, the target. Is this moving you towards your personal or family or financial goals? And then lastly, what is it that you want from the investment? Is it cash flow? Is it tax mitigation? Or is it, maybe a higher return for a longer period of time, like storage, right? So storage is like, it's riskier, but you might get a better multiple at the end. If they can roll up and sell to private equity, you have a bigger bang on the end, but maybe that's not what you want to do with all your money, So I think you have to really mitigate your risk by looking at the diversity of your portfolio, finding what you like, finding who you align with. And then at the end, like, is this target, is what you're doing bringing you closer to your financial, family, or personal goals? That's really what we do every single time we look at an investment.
Beautiful. Have you ever done a 1031 exchange with any of your triple N that you're exiting into a multifamily? Is it something that is common? And if yes, what's it like? What are the things that people should consider?
No, I haven't done 1031 to multifamily, but I have done commercial 1031 to triple net. So
Okay.
I've done that. I'm looking now at doing one 1031 from triple net into a business acquisition. It would be another triple net sale leaseback to ourselves for a business that we're looking at. So I feel like I haven't done it into multifamily. It is possible, but my concern is always this going into multifamily with triple net with a 1031. Two things: timing. Triple net is pretty on timing wise, but the multifamily can vary closing dates. And if it's too long, you actually could lose, your attempt at the investment. If you know the person, the best thing to do is get in before they've created a PPM and an OM, speak to the GP, say, BB, I have 250,000. I need to reinvest into a 1031. Can I be, because you're not an LP at that point. You have to have different ownership. So you have to talk to that GP prior to the offering, or the offering has to be amended and sent to everyone, right? So it's best to get in the 1031 beforehand. You're looking to 1031 triple net or commercial into multifamily. I would suggest you speak to some sponsors, see what they have coming up, evaluate, see if it aligns. If it does, then move forward. Make sure that the biggest thing is with triple net or with 1031, you have 45 days to identify the property that your money will be going into, and you only have 160 days to flip it in. You have like 180, 6 months basically. So it's timing and it has to work, or you lose the opportunity and you pay capital gains. So there is some risk. You have to be very calculated about the steps you take in order for that to happen so that you can both benefit.
Oh, we lost a 1031 exchange transaction last year. We're trying to do a 1031 exchange and we missed the timing. So it's not because we're not going to do a deal that did not pencil out. So we're like, okay, fine. We have K1s to write it off. No problem. That was our.
Some people don't, right? So that can be detrimental to them from a tax perspective, unless they really know that like this deal is going to happen for sure. There's a closing date, that they know that the sponsor can raise the money in time, or they have that's the other thing. I always ask sponsors, like, do you have the personal money to come in and close this deal if this deal, something happens where you don't have enough funding in time? Because that is urgent and important if you're 1031ing. So like asking the sponsor, do you have the $1 million if you're short? How are you going to manage not getting closed on time? Do you have something to leverage against? Do you have a HELOC? Is your bank allowing you to have a $500,000 rotating line of credit if you can't get it closed? So those are now, like, I didn't have all these questions in the beginning. I was like, oh, you know what? He's really awesome. He or she is a coach. This girl's doing a great job. I see her all over the place. I'm telling you, like, I even have a triple net I did a car wash. It hasn't paid me anything. And the sponsors they're super popular. I know them. And car washes are great. So I'm like, maybe business coaching, because I'm like, I don't understand how we're not getting distribution. So I think it's really important. Like I said, it's not just about, oh, they look good, they're all over, they need to have sound advice. Like, I need to know, I can look at your financials. I need to know that if I want to look at your PFS, you can verify. I want to know what you've done in the past. What's your business experience? Like, I think it's important just from an LP perspective to be really critical of who you're investing. I think a lot of people just jump in like, oh, I like them, or I've seen them do this, or I know that's great. But I'm telling you, like, the ones that I did the worst investments I have are the ones that I assumed
that way. Exactly.
That they were so high level and they have all this fame and fortune for what they're teaching. And yeah, it's a problem.
I have a lot of questions to ask you, but I will not be able to. But really, it was a very interesting conversation with you. And now the audience is aware that they can easily diversify. If you are targeting cash flow, triple M might just be what you need. But if you say, no, I need something to write it off, or I need appreciation, I need other benefits, you can look at multifamily. I don't do storage, so I can't speak to that right now. But I know multifamily gives a lot of benefits, and I'm benefiting from triple N. So I can tell you for a fact that yes, for cash flow purpose, please go there. I know you can talk about this. I know you have something cooking up in the pipeline and all that. Just
I always have something cooking, baby.
So just tell us.
So a couple things. I know that you had a few questions on here I didn't get to answer,
Yeah,
but one of them I did want to answer. I know you had sent me something about like economic cycles and the impact of
exactly.
like
I
that.
wanted to add that. Yeah,
Yeah, and on interest rates. So basically why we buy cash is so we're not affected by economic cycles.
exactly.
For folks that are buying triple net with debt, right? It's usually a 5-year cycle of debt.
Mhm.
Our terms are usually 10, 12 plus more. So if you're buying with triple net, if you're buying triple net with debt, you have to be really, really conscientious of variable debt and renewals, right? Your
Mhm.
renewal debt, because we do something, all of our leases have a 2% annual increase built in to combat the inflation. So if we buy at, 10,000 month rent, every year that goes up 2% for a total of 10% every 5 years is about the average. So our pro forma is already set. You can see every year it tells you exactly what you're going to make. There's no surprise. So you can project debt based on that, right? So if you think, okay, well, I'm going to take debt out on this, you're going to have to see, okay, if I can increase this by 10%, what is the worst amount of debt that this could absorb and still make money and still pay my LPs, right? We don't have that, but I think that's something that needed to be brought up because you need to understand these are already preset. It's not like, okay, we can increase our rent 10%. That's not what happens. It's already preset. So I just wanted to address that because people might, that's very different than multifamily.
It's very different. Yeah.
Okay,
What about
yeah.
people that are doing triple net for commercial properties? We are seeing a lot of downsides to commercial properties. What would you say about that? What's the effect if they actually took a loan on it as well?
Yeah, I think it's huge because, for example, if you have a commercial property like retail, mall,
Yeah,
since COVID, there's been a vacancy issue. Office space, like don't ever do triple net office space. I mean, that is just a bad idea. I don't care if it's brand new. I know people that are selling it right now that are building it. I'm like, first of all, unless you have a triple net corporation coming in buying 90% of the space or something, right? You have to be very calculated, BB, on what you're buying and who your renter is. Like, who is the acquired client? And how are you going to stabilize that for everybody? How are you going to protect your investors? Are you willing to put your own money in if this vacancy goes down? Because that will affect it. And then financing as well. When you have to refinance, right? These things, if you don't own it, you're forced to refinance. I am not forced to do
you're
anything.
not
My
forced.
can hang out till it goes back to 4%. And then we're at 10%, in rent. So I think, again, mitigation of risk has to be calculated from a longer term portfolio or profile, not just in the moment you get to buy it in. These folks who are buying triple net, they don't understand that. They're buying in the moment like, oh, well, our cap rate is 8. It's great. My debt is whatever. But right now, most triple net, if you buy with debt, you're upside down. So if I buy
Exactly.
$4 with
Already.
debt right now, okay, my debt is going to be 8% and I'm getting a 6% cap rate. So I literally would get in less than I need to put out to pay the debt, unless I'm doing a 60-40 or more leveraged.
Yeah, this is super, super educative. So for you, it's more of the strategy than triple net. Triple net can be anything to anyone, but the best strategy is what you should consider. And also, I like Julie's strategy, the tripod strategy, where she has the triple N, multifamily, and other investments at the other end. You can consider doing your investments like that. I'm one person that tells you that don't put all your eggs in one basket. Don't just do one thing. Even if you want to do just multifamily, try and do it in different states. We're having that
And
conversation before we
even the
started.
amount you're
Yeah,
putting in, like
yeah,
you don't have to put in a quarter of a, if you have a capital event, I will tell you that was a mistake. I put too much in each one. I should have
yeah.
diversified half of what I put in and made, was able to just be even more diversified and more risk
Exactly.
averse.
You'd have scaled more too. Yeah,
Yes. And so I've learned so much in the past, 5 years. I mean, we always had our own triple net because we had our business. So we leased back to ourselves, which is how it started, right? Then
yeah.
when I sold my business, I was able to sell all of the real estate to an investment group that paid me on the multiple of the entirety of the portfolio. That's again a huge multiple, right? But
Exactly.
even if you're doing this on a 1, one piece deal, you have to be cognizant of what you're buying, what the rates are, whether you're going to go with loan, no loan, or partial loan, whether you're going to bring LPs in, whether you're going to do it alone, whether you're going to JV with one other partner or two other partners, lots of ways to skin the cat. At the end of the day, you have to be profit positive. I mean, that is really where you're at. So killer strategy, because of my age, the 4 kids, where I feel comfortable, I am a little more risk averse. That's just my nature. But some people who are 30 can do this in a very different way, right? But I'm not,
on their side.
I've matured a little bit and learned a lot. And so I just try to be you cannot control everything, but I feel like the more that I feel like we have the risk managed, I feel more comfortable. So that's just what it is. And you were saying, do I have projects coming up? Yes, I always do. We will have.
So how can they reach out to you?
TheJulieRoy.com is our website. You can always, reach out there. My email is just julie@thejulieroy.com. There's my phone number. My emails are on there. We're pretty quick to get back to folks. Yeah, my personal Facebook group, you can find me at Julie or The Julie Roy on LinkedIn, Insta, Facebook, but we have a really tight kind of a few thousand people network. It's called Your Business Bestie. I do a lot of business advice because that's really what I coach around, is helping people grow their equity. And then when they sell, what do they do with their money? Because we've had a direct path, I've learned a lot and I've done a lot of mistakes, which I feel like it's my duty and my give back to not have people do those mistakes if they don't need to. But we always have projects coming up. We will have another one by year end. Again, it's tight, small, 15, 20 people max. We have to know you, or you have to know somebody. So like if you know BB, then she could refer you.
You know you so.
Right. So, but so there's always something available. We do a few Starbucks a year for sure. And then we add in some other, always some other adventures. But so BB, I just want to thank you so much for having me on here today. I'd be more grateful. And I can't wait to actually see you in the human flesh at some point.
Yes, we will. Thank you so much, Julie, for taking out this time to being with us. I really enjoyed it. It was just a conversation. It felt like I was talking to a bestie. We were just talking and chatting. And I'm sure the audience also enjoyed it. And for the audience, in case you're not following us on our social media platform, we are currently on YouTube. And the reason why we're on YouTube is to give out educational content. We don't want people making mistakes. You heard what Julie said. She has made so many mistakes and she's putting out her coaching out there to ensure that people don't make that mistake. So that is what we are doing in Blue Oceans. We are trying to bring out our experience and other people's experience and gathering them all together in form of content so that people can go through them, listen to them, and continue your multifamily journey. And it's absolutely free. There's no money attached to it. I started my multifamily with freebies, and before I started doing multifamily, then I made money. I started joining communities that were paid, but I started with freebies. So you can use this to start on your multifamily journey. So we're on YouTube as Blue Ocean Multifamily Group, on Instagram as Blue Ocean _ Multifamily Group, and on Facebook, Blue Ocean Multifamily Group, and on LinkedIn is Bibi Ofiri. You can find me there on LinkedIn as Bibi Ofiri. Thank you so much. If you're looking for an opportunity to start your multifamily journey, you can reach out to us. We have some things in our pipeline. And if you're looking for opportunities to invest in Triple N, which I'm currently in with Julie, through a mutual friend, you can contact Julie through our Facebook and also through our email. That's Julie at the, I missed it, right? Julie at the
JulieRoy.com.
At the JulieRoy.com. Yes, so you can get across to her and ask her. I would say reach out to Brooke. I will send you our information, or reach out to Julie. Any of them, reach out to them.
Perfect. And lots of folks know Brooke, and she has GP'd in our deals as well, so she can help you out. But absolutely, I'm very.
So if you can reach out to Julie, reach out to Brooke, and you get on board with their team. Thank you so much, Julie, for taking our time to be with us. And audience, without you, we wouldn't have done this. Thank you so much for being patient. We normally don't stay this long, but I'm sure you enjoyed it because it was an interesting conversation. Thank you all and have a wonderful day.